Hey, welcome back. And in today's video, we're going to talk about some of the investment advice that many famous investors have given over the years and how it's led them to outperform the market and perform far better over the long term. So let's get right into it. There's a lot of advice out there from investors and online personalities who love to preach. But with much of this advice contradicting each other, it's hard to really tell what you should do and how much of this advice is just noise. So let's try and figure out what we should truly be listening to and try to decipher that signal from the noise. And I believe that the best way to find good advice on how to pick individual stocks is by identifying those with excellent track records over long periods of time and considering their investment philosophy and trying to adapt that to your own personal style and goals. Now, in this video, I'm going to outline some of the best advice that I have personally heard from many infamous investors and even some that you probably haven't heard of before, and see what we can take away from their professional experience in managing money and how we can use it to our best advantage. Now, with that, the first piece of advice that I think is really important is one by Warren Buffett. And he says, if you don't feel comfortable owning a stock for 10 years, you shouldn't own it for 10 minutes. Now, this quote is quite counterintuitive to the way that many people invest, where they try to find the best deal they can in the moment or invest in companies with just low valuations, waiting for them to gain favor throughout the market and return to a more average multiple, making them money in the meantime. But the question is this the best way to invest your money over the long term? Well, Warren Buffett thinks that this is not the best way to invest. And here's why I believe he's correct. Anyone who attempts to invest in individual stocks, even just over a couple of years, knows that the market is a challenging place to make money. When you pick stocks, there is a high chance that you are wrong, and the investment may be offering poor returns. This difficulty is only magnified when you're also trying to time an opportune entrance and exit into a stock, not based on the quality of the business, but rather just the current multiple or the market sentiment at the moment. If we take a moment to think of investing as a basketball shooting percentage, where NBA players only make around 40% of their shots, most investors have approximately half of their investments underperform the market. This can make adding another variable like a time constraint, whether that means you're using options or you're just trying to time your way into a stock and out of a stock, even more challenging to achieve market-beating returns. Now, this means that many of your investments will have to compensate for the losses in your other positions. However, when the market experiences large swings up and down, there are many times when a stock you hold soars up far above where it really is intrinsically valued at. And if you're trading it, you might sell out and miss out on a significant portion of the returns that you would have gotten. Now, this problem only arises when you're selling in and out of companies consistently and you have a large turnover in your portfolio. And this problem can be completely mitigated if you only invest in companies that you believe have a long runway for growth and only sell out of them if your thesis changes, rather than trying to time certain swings in the market. And what I'm trying to convey here is not that investors shouldn't consider price when entering into a position, as you should certainly consider price as a large component of whether or not you should buy a company at the moment or not, but rather that valuation comes second to business quality and the competitive advantage that the business has. In my opinion, you should first consider the long-term competitive advantage that a company has, as well as the management team, the product suite, future growth drivers, and more before you look at the valuation, because valuation can change far faster than the underlying business qualities that a company possesses. Now, starting off with this quote from Peter Keefe, where he says, "There's only two kinds of people in the investment industry, those who are humble and those who are about to be humbled." Now, I think this is great advice because I think it's really easy to feel smarter than others when you're outperforming them or you're beating the market, but there needs to be a level of gratitude and perspective when investing, as many who become successful investors over the long term are the beneficiaries of some level of luck. Now, investing can take a 180-degree turn very quickly, and just when you think you're unbeatable and your process is just unmatched, your portfolio could take a long period of underperformance. So it's important to remember that we are just humans who will make mistakes, especially when investing, and that we all have our blind spots and our weaknesses, because if you don't, this hubris could lead you to far worse investing mistakes. And another way to look at this is that the odds are that there's someone out there looking and reading and watching the same things that you are. And considering that, you probably won't be the smartest investor in the market. But one way to get an edge over other investors is to practice a level of humility that will pay dividends in all aspects of your life, including investing. Now, this piece of advice by Bill Miller is really counterintuitive to what a lot of investors are doing, whether that's on CNBC, YouTube, Twitter, or any other forum. And what he says is, there's very little value added trying to predict where the market is going or guessing whether it's overpriced or underpriced. Now, implementing this piece of advice can reduce a lot of the noise that many retail investors hear, whether that's on YouTube, Twitter, CNBC, or on newspapers like Barron's, Wall Street Journal, and many others. Now, I say this because many investors attempt to sell out right before a really large downturn in the market or a big correction and end up missing out on large returns. And what Bill Miller thinks about this is that you should not waste your time trying to predict these large macroeconomic events, because honestly, the few that have been able to do that in the past are the exception to the rule. Many investors get it wrong or get the timeline wrong and end up underperforming what they would have done if they would have just stayed in the whole time. And I agree with this advice because there are far too many variables in the economy that is so interwoven with many other countries and factors all across the world. And plus, you don't even know how the market will react to this certain news or certain event, because the market can stay irrational for long periods of time. Now, for example, if you look at Michael Burry, who predicted the 2008 financial crisis, he figured out that the housing market was primed to crash, and he bet his entire portfolio on this one macroeconomic event. However, it took nearly 3 years to come to fruition. All the while, he was paying a large amount in interest on his short position and having investors angrily emailing him saying that they want their money immediately. But luckily, he was a very well-funded institutional investor with a solid track record. But let's not pretend that we are Michael Burry and we have the resources to pull off a trade like this. Because not only is it hard technically to understand and execute, but it's also extremely emotionally difficult to get through. And you need some level of superhuman conviction to execute something like this. And I think it's important to realize that what would have happened if he would have failed? Or the timing would have been off by another year or two. Would he have been able to support that amount of interest payments? I mean, his fund most likely would have collapsed. And can you afford to do that with your life savings, with potentially a family that you have to take care of? I don't think so. Now, none of this is to say that you should never consider macroeconomic events when investing, especially if you have a shorter time horizon, but rather that focusing on individual companies at a more granular level can offer more consistent returns when compared to making bets on large macroeconomic events that require pretty precise timing and countless variables to align. Now, this next piece of advice comes from Howard Marks, and it kind of ties into what we were just talking about. And he says there's a big difference between the probability and outcome. Probable things fail to happen, and improbable things happen all the time. Now, Howard Marks is a very famous investor whose funds have produced long-term returns, net of fees, of 19% per year, outperforming the broader market by a wide margin. And this quote is incredibly telling of how the markets present a lot of uncertainty because of all of the variables that are unpredictable that happen all the time. Now, Marx also outlines a story that exemplifies this phenomenon when he describes an investment that he made in a Florida company going through a merger and acquisition that was looking to be highly accretive to shareholders. However, just as the deal was going through, the headquarters fell into a sinkhole, eroding much of the value of the deal for months on end. Now, the company's value did eventually recover somewhat, but because of the natural disaster, the return was dragged out far past the initial timeline, making it something that dragged down the portfolio instead of pulling it up like they had thought. Now, the lesson to be learned here is that the only certain thing when investing is that there will be uncertainty. With that assumption in mind, you have to attempt to reduce risk in your portfolio by preparing for black swan type of events. This risk is often accounted for by diversification, but of course you don't want to diversify so much that you miss out on the outsized gains that concentration often enables. Now, the next piece of advice is from me. And no, I didn't come up with it myself, but I've heard it through almost every single investor that I've listened to. And the really successful ones continue to say and double down on the fact that too many people cut their flowers and water their weeds. And when thinking about investing, that means that you trim the positions that are performing the best and you increase your position size in ones that are performing the worst. Now, you may think hearing that, why would anybody do that? But if you have a similar level of conviction on two stocks, and one is underperforming and one is outperforming, many investors see that as an opportunity to buy into the company that is underperforming. But many times, that doesn't prove to be the best option, as companies that are proven to execute over time usually continue to execute, and those who don't continue to underperform because they can execute. Now, this idea is one of the most popular pieces of investment advice out there, but for some reason, it is so hard for investors to follow. In my opinion, I think it's important to double down on your best ideas and not waste time or capital trying to place bets on your 10th best idea or 20th, because the likelihood that your 10th best stock pick is better than your first, second, third, fourth, or fifth is highly unlikely. And I think it only offers to diversify and actually make you underperform over the long term. And to back this idea up with historical returns of the market and some stats to really see if this is the best way to invest, I think it's important to know that 4% of all the stocks accounted for 100% of the returns in the S&P 500 since 1926, which means that if you find a company that is part of that 4%, you should certainly add to that investment over time rather than trimming it, as it has the potential to make up for all of your losses if you're just able to hold on to that stock. And oftentimes we think that if a stock runs up 100%, that we should take some off the top, because as the saying goes, no one ever lost money taking a profit. And this advice, although true on the surface level, could not be more false when thinking about the opportunity cost that comes with trimming a strong performing investment that could compound for decades. Now, for example, if you invest in Apple in 2004 and rode the turmoil that brought the stock up over 1,000% in 2011, you certainly would have made a killing. But what if you were to decide to trim some of your position because it was just far too successful and you didn't want to be greedy and hold on to a stock that had already made you so much money? Well, if you trimmed your position at that point or even sold out of it entirely, you would have missed out on another 1,100% return over the next 12 years. That goes to show that if you are trimming your positions that are performing well, then you have the wrong mindset and the wrong incentives, because you should be rewarding companies that are proving to you that they can continue to perform. Now, this isn't saying that if a company has a large run-up during an extremely frothy time in the market, whether that's 2020 or a dot-com bubble type event, that you shouldn't sell or trim a little bit. But what I am saying is, if the fundamentals are improving at such a rate that a company is outperforming and becoming an outsized position in your portfolio, you should not punish that position because the management team and company is executing very well. All this is to say that you should evaluate companies on their fundamentals. And if their fundamentals are improving at a rate that an investment becomes an outsized position in your portfolio, then you should not reduce that position if you have a long-term time horizon, because it's proven time and time again that that will reduce your long-term portfolio returns. Now, in conclusion, there is no one rule to invest properly, just as there is no one way to live your life the best. However, if you are able to take advantage of some of this advice and the knowledge from investors that have come before us and already won this game, then I would guess that you would be quite successful in outperforming the market over the long term. And it's important to keep in mind that these rules and advice are not easy, but they are simple. And there is a great amount of alpha to be had for those who are able to achieve these challenging goals. Now, this isn't any advice on your particular position or portfolio, because I don't know how you pick your stocks or your ETFs or index funds or whatever you choose to invest in. I'm simply just sharing some of the advice that really successful investors have and how they look at the companies that they hold and invest in and what I'm trying to learn from that. So please do your own research and don't buy or sell because some idiot on YouTube said something, or investing, and see if there's anything to gain here. Now that's all I have for you in this one. I'll see you in the next one.